Good evening, Nick Inman here from VolumeProfileTrader.com on Monday, April 9th. And S&P market as a whole moved down today, basically confirming what the futures told us on Friday. Weak jobs report leads to disappointment in the market, and the market sells off about 1.5%, where we now are basically at the bottom of the channel, the bottom end of the range. You can see the Donchian is basically prices at the bottom of the channel. You have 50-day moving average prices there, and on a volume chart we have this 1370 level, which seems to be support for now. You can see we stabilized within this high volume area from earlier in March. If I kind of bracket this range and emphasis on this 69 to 66 range, but you can see that price has slowed down. We've sliced through the light volume here, and now we're waiting to see what the market's going to do. The market also had a pretty nasty sell-off at the end of the day after a 3 or 4 hour rally off of the lows. Came back, and the last 20 minutes or so of the day washed out pretty much all of the gains. I don't necessarily think this market is going down. What I think is important, though, is watching for the Spanish bonds tomorrow when European markets open again. If Europe's weak, if the Spanish bond yields are high, then it's going to be probably an ugly day in the market in general, and we're probably going to see lower levels. If it stabilizes, then maybe we get a little bounce here back up towards 1390 or so, 15 point or so bounce to close the gap or get close to it from Friday's report. XLF took it on the chin. You have a decent amount of regretful buyers. The shorts up here are successful, and they're enjoying this trade. You're coming down to the 50, you're coming down to the point of control for the year. That's going to be an opportunity to be a buyer of the XLF at these levels. I don't think that you necessarily shy away from these levels. Last time we got a pullback to the bottom end of the channel, it was a nice buy. Look for it again, $15 or so on the XLF, or about 2% from there. So it shows you we have more potential downside, but at least you're there then at a point of reference. You're at a good spot in the market, in the financial ETF, that shows you, hey, potential support. Alright, XLE kind of falling through. I would be looking more towards the mid-60s, bottom of the value area. This appears to be range bound from, I'd be looking at basically these main lows in the XLE as far down as 64, but I'd be looking more at around 67 or so, more towards these most recent lows, but it's slicing through these moving averages, trying to hold, but not doing a very good job. To cover a name that I continue to follow, ConocoPhillips, trying to keep up, but continues to kind of roll over. Any kind of pullback, though, you can see ConocoPhillips is outperforming the XLE. Similar, but ConocoPhillips, if it falls down to its high volume area, 72 or so, that's also at the 150 and 200-day moving average and the point of control for the year. That's where you want to look to be a buyer. It just happens that if you're looking on a 90-minute chart, or I'm sorry, a 90-day chart, the point of control is for the 90 days at the very top end of the range. It's toppy here, and it's just looking for some type of value between 76 and call it 73.5. There is no value, so I wouldn't be surprised if we continue to slice through. What you are seeing, the only reason we are holding these levels is you have what was resistance close to support. You have the 50-day, but I really doubt these levels hold. I would consider more downside. Alright, XLI back to the bottom end of the range. I think it's a similar situation. However, I do think that down to 35 or so will hold on XLI. We are at the bottom end of this range though, so maybe this holds. I don't think there's really much outperformance here though. This isn't where you want to be as far as a potential sector. Utilities hang in there. Got beat up a little bit today, but for the most part hanging in there. As long as we kind of keep up this general upsloping path, this isn't a bad place to be, especially for market uncertainty. Healthcare got beaten up today with the rest of the market, but this was on light volume. Metals and mining actually did fairly well today, as far as they didn't outperform to the downside. Kind of stuck and, down 0.5%, but that's better than the market. And maybe we get a potential bounce here. What you're looking for is point of control for the month of August to come down to these levels, to this 47.60 level or so. That'll give you a sense there's either enough buyers here or enough people who have sold short. And if this thing gets starting to pop to the upside, those shorts will cover, or those longs will add on, and you'll find a few more buyers. Now there is a chunk of resistance in here, so you have to be careful. I would be trading against last month's profile, which would lead you to a target of around 49. Not that great of a bounce, but then we could get it as high as 50 or so before you would look to take some risk off. Gold gave us a nice bounce today after the disappointment in jobs. Basically, shorts covered, and we got that bounce off of that. What you're seeing here is a little bit of resistance off the point of control in March. Just keep an eye on that, 1650. If we get above there, we'll push up towards 1665 or so, and from there we'll probably push towards 1700 to the short side. Let me zoom back in. The trade back down to 1627. That's your point of control for August. That could matter, and then from there you look towards 1593, and if we get down there, that could be a decent buy off of December's point of control. Silver, as much as gold's gotten beat up, silver's just kind of hanging in there at this range. No real reason to look to be a seller as far as, for a flush out. It looks like we have to get some more selling pressure to do so. On the monthly charts, if silver stabilizes here, it's kind of going to remind me of something that oil did a couple months back, which was trade under the prior month's lows and then basically reject those levels and make a new high. And if you kind of look at silver, we are trading similarly, basically under those high volume area, or the high volume area from March. We traded the top of it in August, failed, sold off. We've made new lows, but just marginally. So if we pop back into this 32 range, we should go test 33 if we can get above March's point of control, and that would lead me to believe that 32 is your new support, and we have the potential to look at higher prices on silver. Okay, going through a few names. GE point of control for the year, bottom of the channel. This is a low risk opportunity. You place your stop. This is the trade. If GE makes a new intraday high tomorrow, you place your stop under today's intraday low, and you look for a bounce back up towards $20 or so. Medifast, this is a stock I featured over the weekend. The fundamentals are great. Short ratio, or short interest, is pretty high, and looks like we have a pop up to 20, to say the least, and really could get going. Similar, it kind of looks like a little bit like AIG, where this was a ceiling for a while and pushes out to the upside. If you look at Medifast, similar phenomenon. All I have to do is zoom in a little bit, and you can see how we're starting to break out. So we just want to see that continue to the upside. Just be careful, the volume's not great. It's traded over 1 million shares about a handful of times over the last year, it looks like. Maybe 6 times or so. So just something to be aware of. Agrium, this is a name I started to nibble in today. Down almost 1.5%. We're still, we're at the top of the 52-week range, and there is potential for a move down to the low 80s. So that's why I kind of bought small, but this is a name that I want to be involved in because I do believe in the longer story. Really, ultimately, what I'm looking at is for a breakout from this broad range, really from, the way I view this chart is about 79.5 up to about 89 is your big pivot level, $10 pivot level in this name. If it's below it, right, as far as recently in the past year, if it's been below it, it's been right to really be a buyer, and if it's been above that level, it's been right to be a seller. We're in the middle of that range, and we have the difference between when it was moving lower and now is, one, you have 200-day, 150-day, which were rolling over. Now they're recovering, so that indicates to me that we're in a big range. The moving averages are just simply kind of twisting around price, and that's fine. So that's just something you want to be aware of. But really, kind of like how Las Vegas Sands did, it traded around in a range for a while when eventually it broke out, and we had a nice pop to the upside. Alright, so speaking of Las Vegas Sands, I bought some calls in Las Vegas Sands, the 57.5 April monthly calls, and the delta on them was about 60. So for every $60 LVS moved, I captured 60 cents of price action per contract. And then to be honest, I did this right when LVS was around a break even, and it rose $1.86. Those calls were worth more than 50% from where I bought them, and was a great trade. Took most of them off, keeping a little to ride, but kind of being a little prudent here. CVR Partners consolidating. Want to see these levels hold, these general 26 range or so. If it doesn't, I will reconsider, but I do like what's going on here. Apple, new 52-week high, new all-time high, not a big deal. American Express falling down a little bit, just watch out. CSX, a little worrisome how it fell back into the range, but I'm going to continue to watch this, hold a small position, and wait for this thing to see if it can break back up to the upside. Oracle, I sent an email saying I trimmed half of this position for just about a break even. I think it was a small profit, and it was the 29/31 call spread. Put it on last week when Oracle announced earnings, and it's basically floundered since, and I've been looking for a move higher, and we're not getting it, so I'll take the small profits, I'll limit the risk, and see what goes on from there. Potash, this is kind of my line in the sand, down below 42, so it has a little more to go, but the position, I had to trim some of it over the last couple of days just to reduce some of the risk. Not that big of a deal, but I don't like trimming because I'm wrong on the timing, and the potential that, what if, and this is just something to consider when you're trading, what if this you have your consolidation range. And what if this right here is just a lower high down to new lows? And it very well could be, and that's the reason why I trimmed some risk. It was just prudent to do so. Riverbed, aren't you glad you got out of that call position when you had the opportunity? Now that call position is probably down a lot more. That's why it's important to be prudent. Hewlett Packard, still continue to think this is a place where you want to start accumulating stock, and the reason why is because if it goes below, you can either use these most recent lows or the lows made back at the end of last year. But if we go below there, then you can simply scale out. But if these are the lows, you're getting in at the lows, and you have about a $6 or $7 upshot on a $23 stock. That's not too bad at all. So really, that's it. Not much going on in the market. Gotta wait to see. You have some earnings coming out this week, so that's something to be aware of. But from there, have a good night, and enjoy tomorrow.